but can't be here tonight. And so I see Michelle signed in. Welcome. And I guess before I just launch into my little presentation I have on this week's material, are there any questions, Michelle or Sister Paul, before I do that? No, I see a no and a.
Sorry, I have question.
Okay.
I just try to tap and save your time, but the rush the time, so maybe I can say for the last week, two questions confused me. First one is I think is assignment. The question is all over the counter receipts are entered in cash register, so belong to which principles? So the 6 principles for except physical control and the human resource control. Then the four principle confuse me how to distinguish well for some question. Well, first, do you understand what my question? The first question.
I don't exactly understand the question. Maybe if I could see the question, was it from the homework or from a quiz, or what was it from?
It's for the homework.
Okay, let me pull it up just because.
Let me. I almost tap finish.
Is this from last week's homework or this week's homework?
Last week. Week. Okay.
Or do you want to share your screen, or do you want to?
I just write down the question because I prefer to it's the question here. All of the counter receipt are entered in cash register. So we have to choose belong to which principles for this question.
Mm-hmm. So the reason I want to read it is because I'll be honest and tell you I hate these kind of questions. Because
okay.
Never ever in real life do I have to sit there and think, which accounting principle is this about? Like, it's totally a fake thing made up for textbooks. Sorry, like the accounting principles are real, but as far as having to like select which one matches with a given scenario, because often multiple ones do, and that's why it's so hard to clearly distinguish when you're looking at a written question with that information. And so I want to pull it up and look at it so that I don't tell you wrong.
Okay, so let me try to find it.
Or I can find it. I have it. Let's see.
I think it's the homework, but I cannot remember it's which question. Is the part 1 or part 2?
This is chapter 7, right?
Yeah, chapter 7.
It might have been on the quiz. I remember the question.
Oh, you remember? Oh, yeah. I find it. It's exercise 7.4.
Brief exercise 7.4 or?
Yeah. Brief exercise 7.4. It is the part 1.
Okay. So let's see. This is identify the internal control principle that's applicable to each procedure. And then A was all over-the-counter receipts are entered in cash registers.
Yeah.
And then it wants us to choose from between physical controls, human resource controls, independent internal verification, segregation of duties, or established. Is that the right one?
Which one?
Well, just I'm looking at the right problem. Is that correct?
Yeah.
Okay.
Yes.
Okay. So yeah, so like I said, I hate these kinds of questions because I feel like they're not. They're
so much
because I don't feel like they're.
Confuse me so much.
Yeah, what's confusing about them is in the real world. Again,
yeah,
we want to make sure we have adequate physical controls, adequate human resource controls, etc. We want, so these things are real things, but we don't have to like read a word problem and then match it up like that in real life. So it's confusing. So our over-the-counter receipts are entered into our cash registers. So what this means, so for example, when I was a kid, my mom owned a store, and I would work in her store. And there were times when people would come in, like they would buy gas at our store, gasoline, and they would just come in and drop money on the counter. And it was a big temptation for me as a teenage kid to just sort of like take that money and put it in my pocket. Why? Because there was no way of tracking it. So instead of doing that, we had a process in place where I had to enter that cash into the cash register, and now there would be a record of it, and that would allow my mother to match up the amount of money in the cash register with the amount of money that was on the entered into the cash register. So this would be what we call a physical control. There's some process by which uh, all monies that are received are entered into the system, in this case through the cash register, so that they can be accounted for. So that's a physical control. Does that help at all?
Why is the physical control? I think I make it wrong 3 times. I cannot remember first time. Because confused me is the segregation of duty or the independent internal verification.
Right. So segregation of duties would be where we don't let just one person handle all of the money. So me entering any physical cash received into the system doesn't necessarily mean there's a segregation of duties, especially if I'm the person who has to count out the cash register at the end of the night. So instead, like our business, I would be entering it into the cash register. That was one cash handling duty. And then my mother, who owned the business, she would count out the cash drawer at the end of the night and make sure they matched. That was a segregation of duties, having two people who split up the cash handling.
Okay. If the question said a true person, so will be this answer. So it
Right.
will be the segregation.
Right. So it's a physical control because the question is, what happens when you physically receive payment? What do you do with it? What process do you have of ensuring? Um, so yeah, and I don't want to say that two people necessarily means segregation of duties. Let me give you one more example. So I'm the treasurer for our local youth soccer league. And when we have registration events and people bring in cash, people will pay cash. Um, and we always try to have two people present as we receive cash so that nobody could steal any cash. That's not a segregation of duties. We're not splitting up the duties. That's having two of us. Our rule is two people present. Then we count up the cash, and this actually happens in the church too, right? We receive the money from people when they pay our tithing, and then I give the tithing to the clerk, and then a member of the bishopric and the clerk look at that amount together, and then they both sign off that they've seen the same amount. So that's a form of physical control, even though it involves two people, because we're not splitting up the duties, which is what segregation of duties is. Instead, we're ensuring when we've received money, we follow the appropriate process.
Okay.
Does that help,
Understand.
or be more, or is
Yeah.
that more confusing?
Yeah. For my understanding is the segregation of duty that the two person do the different duty, but the
Right.
physical control is the two person do the same duty.
Or just any,
No, if
yeah.
for the two person, like
So
you said, the tithing part, the example that
mhm.
way.
Yeah, so physical control would be any rules we put in place about how we handle the money. Um, so the fact that as a bishop, I take the money and I do not open the envelope until I'm in the presence of a clerk. Um, that's a physical control issue, how we manage the money, what physical rules of handling that we have to follow.
Okay. The sixth principle is so complicated. Okay, I have the other question. Is
Okay.
for the bank service charge. When you entry the account, so because I watched the video that the Brad Fox you made it,
Uh-huh.
and the bank service charge. Since I saw, I think a similar question. You choose the Mrs. Seller Express. But when I do the exercise, they say it's a bank service charge. So here confuse me when we should choose the bank service charge or the miscellaneous the expenses.
Sure. So again, so if you're doing this in real life, so if you are an accountant for a business, they'll have their own chart of accounts, and the chart of accounts is just a list of all the accounts that they use. Some businesses we'll just call it service charge. That'll be the name of the expense that they use when they have to pay a service charge. Some will call it bank fees or bank charges. Some will call it bank fee expense. And so the short answer is like, it depends on what accounts are available to you. So it's likely in the problem I was working out that they had bank charge or bank expense or whatever it was as the expense that you would use for that. And on the other problem, that instead they had, bank service charge or whatever it was called. And so, I can, like, if we pull up, do you remember what assignment this one was? Was it the second assignment?
Do you mean is your video or the for the
The
assignment
homework.
homework? Okay, let me find it.
Let's see.
I think it should be in the part 2.
Right, that's right. I think so too. So I'm looking on exercise 7-8 in part 2. Let me share my screen. Let's see. So on 7-8 down here, we have bank service charge. And honestly, the only reason I would choose that is because that's the only choice that they give. So in fact, you'll see, and this is confusing because up here in our reconciliation, we use bank service charge. But then down here, when we're doing our journal entries, bank service charge isn't available to us. Instead, bank charge expense is available to us. And so, for up here in the reconciliation, I'm just using the language that is in the information given to me, that there was a bank service charge of $50. So I go ahead and I put that in. In other words, service charge expense isn't a drop down here. It's not one of the choices on the drop down.
Yeah, maybe
And then,
it's this one.
but then when I do my journal entry, I have to debit the bank charges expense again, because that's what's available to me to use as the account. Another meaningful difference is that here we're just making a reconciliation where we're using a note to show show our adjustments, but in the journal entry, we're actually charging an account. And so the account we would be charging is the bank charges expense account. I'm afraid that didn't give you a definitive answer of,
I For my understanding, I think the miscellaneous expense can include the bank charge expense. Is that right?
Yeah, so the bank service charge is that creates a bank charge expense. Okay, just like the using of supplies creates a supplies expense, or the using of my electricity will create a utilities expense. So that's all that's going on. They're in essence the same thing. It's just that on our reconciliation, we're listing this as a bank service charge because that's what it was listed as on our bank statement. But our account is our bank charges expense.
Okay.
And that bank
Thank you.
charges expense account could even be broader. It could not only be service charges, it could be check fees, any charges that the bank, might charge us, we might lump into that same expense account in real life. Okay, does that help? I hope it helps. I'm sorry if it's, the problem with accounting is even when someone explains it, sometimes it's still confusing.
Yeah, you're right.
It's, you know what else is like that? Parenting. All right. It's still confusing to me. I don't know. Almost all of our kids are raised and I'm still confused. One of my teenagers will do something and I'll think, why did they do that? Anyway. Okay. So why don't I move to the little pre-prepared slides I have? There's just a few of them. And then we can go through any other questions that come up as we look at that. I'm going to pull this up. I'm going to stop sharing screen 2 and start sharing screen 1. And when I make this full screen, that's not right. Somehow I'm at the end. That still doesn't look right. Hold on. All right. So there's a couple things that are new and a little confusing in this chapter. And so these are about a type of assets that are assets based on money being owed to us by other people. So if I loan money to somebody, I have a note receivable, or if I allow people to pay me later for goods and services I've completed, then I have an accounts receivable. Those are assets because it's money owed to me. So there's a couple of ways. There's really only one way to handle these sorts of things, but they want to introduce the idea of this direct write-off method, which almost nobody uses. I think mostly they want to introduce it to show you why the accrual method is better. And by better, I don't mean easier. I mean, gives us a better understanding of what's happening financially. So we'll start with the direct write-off method for uncollectible accounts. So all that happens is under the direct write-off method, and maybe some tiny businesses might use this, the Warden Company writes off M.E. Duran's $200 balance as uncollectible. So this usually happens in real life when the finance manager says, we know we're not going to collect this money, so let's write it off of our books. So all we do is we write a journal entry that's a debit to bad debt expense, and then a credit to accounts receivable. So what we're doing is we're reducing the account receivable, so reducing our asset, and then debiting that as an expense. If you think about it, probably when we sold whatever we sold to this guy, M.E. Duran, or Doran, I don't know how you say his name, but when we sold stuff to him, we would have recorded this as a revenue. And as our cash, or not our cash, but our accounts receivable going up when we made the initial sale. So now we're recording as an expense because we never collected that money. The problem with this is that it doesn't work with the matching principle. In other words, the revenue was probably recorded in a previous period, right, when we sold the stuff to this person. And now we're writing it off as an expense in this later period, which creates all sorts of problems with matching up our revenues and our expenses. And so it's not an acceptable way of doing things. So instead, what we use is what's called the allowance method for uncollectible accounts. This uses accrual accounting principles. So what we do for the allowance method is we estimate the amount that we think we won't be able to collect, and then we debit bad debt expense and credit an account called the allowance for doubtful accounts. And then we debit the allowance for doubtful accounts and credit accounts receivable when we choose to specifically write off an account. So what this lets us do is it lets us take the expense during the same period as we recorded the revenue. The downside, of course, is that it involves an estimate. We have to say we think we're not going to be able to collect all this money, so we estimate how much, and then we make an entry. So the only reason we really do this is so that we can try to match up the revenue earned from selling something with the bad debt expense for when people don't pay us in the same time period. So here's an example. Hampson Furniture has credit sales of $12 million in 2017, of which 200,000 remains uncollected at December 31st. So if you think about that, it means that we must have collected $1 million worth of that, and the other 200,000 we haven't collected. The credit manager estimates that 12,000 of these sales will prove uncollectible. So rather than waiting until next year, when we decide we really aren't going to be able to collect them, we go off of this estimate and we create an entry that debits bad debt expense for the $12,000 and credits the allowance for doubtful accounts. Then in the next year, when we talk with customers or the customers just dodge us and don't answer us at all, and we finally decide, hey, we really are going to write off these expenses, instead of writing them off against the bad debt expense, because we've already claimed the bad debt expense, we'll write them off against the allowance for doubtful accounts. So our balance sheet will look like this at the end of the year. It'll show our accounts receivable of 200,000, less any of the allowance for doubtful accounts. Will give us the amount of accounts receivable that we actually believe or expect to receive. Okay. A lot of times people will call this the net realizable value of their accounts receivable or the net collectible value. You'll hear those terms thrown around and they mean the same thing. All right. Then the Vice President of Finance for Hampson Furniture authorizes a write-off of $500 owed by RA Ware. So we actually have a customer who can't pay us, and the Vice President of Finance authorizes the write-off. This usually occurs when the customer either calls and just says, hey, look, I'm not going to be able to pay you, or if the account ages to the point where we just really believe we're not going to be able to collect it. So when we do that, we debit the allowance for doubtful accounts account, and then we credit the accounts receivable account for RA Ware. Remember, since accounts receivable is an asset, by crediting that account, we're reducing it. So if this person owed us $500, by crediting it $500, we're saying they no longer owe us money. And this will show you how this affects the balance of the two accounts. Accounts receivable had a $200,000 balance. We credit it $500. We now have a $199,500 balance. And then the allowance for doubtful accounts, we had a balance of $12,000. By debiting it $500, now we think we still have $11,500 we won't collect. Sometimes there's what's called a recovery of an account. Sometimes a customer whose account we've written off calls us and says, hey, I finally got that money and I can pay you. So this guy, RA Ware, calls us and pays $500. So what we have to do is first reinstate the account by debiting the accounts receivable and crediting the allowance for doubtful accounts. So if you think about that entry, it's just reversing the one we did to write off the account. And then we make the entry to show our cash going up and our accounts receivable going down. This doesn't impact our income statement because we're only dealing with assets. Okay, so we've already recorded the revenue on this and the expense back when we did the allowance. Okay, so now the question is, how do we estimate the amount that we think we're not going to be able to collect, right? There's actually, we're going to show you 3 ways in this class. But there's more than that, okay? I mean, because this falls to sort of an internal way of calculating it, you can use other ways, but these are the 3, these account for probably 90% of all the ways companies do this. These 3 ways I'll show you. So the first is what's called a percentage of receivables basis. And so usually what happens is management kind of looks at past history and then just makes a decision as far as, maybe in the past they've always shown that about 3% of their receivables are uncollectible, so they just apply that each year. And so it's based on historical averages, okay? So what we're going to do is we're going to estimate the amount that we think we can't collect by taking a percentage of the amount that's owed to us. And then this part's important. Amount of bad debt expense that should be recorded in the adjusting entry is the difference between the required balance and the existing balance in the allowance account. So what I mean by that is we'll take a percentage of the amount that's owed to us, and that percentage, that amount that comes out, should be our target or expected balance in the allowance account. Well, if we have some balance in the allowance account already, then we'll only take the amount as an expense we need to bring the balance up to that. So I'll give you an example to show you what I mean by that. Actually, okay, so I don't have a good example of it on this slide. So let me show you what I mean. Really slow, sorry. All right, so when we get to the end of the year, our accounts receivable will have some balance in it. Okay, let's just say it has $20,000. That's an amount that's owed to us. Think of this as a T account, okay? And then our allowance for doubtful accounts will also have some balance in it. Let's say it has 2,500. So when we get to the end of the year, if history tells us that, let's say 5% of our accounts receivable is not collectible, okay, what we need to do is figure out how much this allowance should be, because in essence what we're going to do is each year at the end of the year we're going to do an adjusting entry to bring the allowance for doubtful accounts up to whatever 5% of our accounts receivable is. So in this case, if I do 20,000, well, that's not a good example. Let's say 200,000 in our accounts receivable. Okay, so when we do 200,000 times 5%, we should get 10,000. So right now we already have 2,500 in this account. So we want to bring the balance of the account up to 10,000. So the amount then that we're going to actually do for our journal entry is we're going to do 7,500, okay? So this is the target amount. And I reached this by taking 5% of the accounts receivable. That will vary from problem to problem. It'll say a different percentage in each problem. So the amount of my entry is going to have to be my target amount minus the balance that's already there. So that will be 7,500. So then we're ready to do our journal entry. where we do bad debt expense, 7,500, and allowance for doubtful accounts of 2,500. So that's how we do the percentage of receivables basis. Is we take whatever percentage is given to us in the problem and we multiply that by our accounts receivable. That'll give us a target amount, an amount we want to bring our allowance for doubtful accounts up to, and then we do the journal entry to bring that amount up. So that's what it means when it says the amount that should be recorded as bad debt expense is the difference between the required balance, which is what I use the term target amount or target balance, and the existing balance. So that's the first process, okay? And actually, this book's only going to show us two processes. So the second one is the aging of accounts receivable. So the idea behind the aging of accounts receivable is that using a single percentage for the amount we think is uncollectible probably doesn't make sense because, for example, money that is owed to us and has not yet come due, we're likely going to collect almost all of that. Okay, so again, this is based on past experience of the business managers, but they found that 2% of the money owed to them but not yet due to be paid is uncollectible, meaning they expect to collect 98% of that money. Money that's 1 to 30 days past due is about 4% uncollectible. Again, in a problem, they would give you this information. In real life, you'd have to work as the credit manager to figure out that information. So what we do is to find our target amount or the amount that we think's uncollectible is we're going to apply these percentages to the balances based on what we call this the aging of the accounts. So there's 27. So this company's owed $39,600 total, 27,000 of which is not yet due, 5,700 of which is 1 to 30 days past due, 3,000 is 31 to 60 days past due, 2,000 of which is 61 to 90 past due, and 1,900 is over 90 days past due. Then they'll apply these rates. So you just multiply it. 27,000 times 2% is $540. 5,700 times 4%, etc. And then we add those all up, and that's the amount that we think we're not going to be able to collect, $2,228. Again, that's the target balance of our allowance for doubtful accounts. So we would subtract any amount that's already in the allowance account, and then that would be the amount that we would do as the expense and in the journal entry. So in this case, it doesn't tell me what it is. That's really tiny, I know. But let's just say, for example, this company already had $1,000 in their allowance for doubtful accounts. We can see their total accounts receivable is 39,600. And using this aging method, they need a target amount of 2,228. So the difference between those two, the existing $1,000 balance and 2,228, means they're going to have to do an entry of 1,228. So then their journal entry will look like a debit to bad debt expense of 1,228 or 1,228 and a credit to the allowance for doubtful accounts for the same amount. So really the only difference between these two methods sorry, let me get this full screen again. The only difference between these two methods is that on the first one, we're applying a single percentage rate to all of our accounts receivable to estimate how much is unreceivable. And on the aging, we're applying different percentage rates based on the aging of the receivables to come up with our estimate. So in both cases, we're estimating, and then we're doing a journal entry to bring our allowance for doubtful accounts up to the amount of our estimate. It's just in the first one, there's a single rate, and in the second one, the aging, there's rates based on how old the accounts are. So it seems confusing, but they're actually very similar. They just use a different process to make that estimation. And again, if you have a question, don't be afraid to jump in and interrupt me, because I'll move on, and then it'll be confusing to come back. The other thing that's new in this chapter, which isn't really new, but it's what's called notes receivable. A note receivable is just a loan that you make to someone else, and it's a formal loan in that it's usually written up in a note. Okay, and a note is just a document where you agree to pay a certain amount. And so that's what a note receivable is. To compute interest, we always use the formula, which we've already been introduced to, but it's the face value of the note, or sometimes people will call it the principal, okay, the amount owed, times the interest rate, times the time. We always do our time in terms of a year because, well, the interest rates are always given in an annual or in terms of a year, okay? So I just always remember principal times rate times time, or the face value times the rate times the time. Sometimes we get terms of the note given in days. If that happens, then we have to follow this rule. When we are counting days, omit the date the note is issued, but include the due date. Unfortunately for me, I often have to count these on my fingers because that still confuses me. And I only have 10 fingers, so I just have to work it out. Anyway, so the principal times the rate times the time. That's how we do it. So when we're in days, they're showing us out of 360 here. Some problems will have you doing it out of 365. You have to read the problem carefully, okay? It's confusing, and I wish they would just all go to a 365-day convention or rule and then be simple, but there's still entities that are using 360. So read the problem carefully. It will tell you either based on a 360-day year or based on if it doesn't, I'll give you this warning out front. If it doesn't tell you based on a 360-day year, then use 365, because that's become more of the standard. And if for some reason it marks it wrong on you, I will give you the points back, because that's an annoyance to me when they do that. If it's based on months, it's over 12 because there's 12 months in a year. And if it's based on years, then it's over 1. All right. So here's an example. Wolder Company lends Higley $10,000 on June 1st, accepting a 5-month, 9% interest note. If Wolder presents the note to Higley Inc. on November 1st, so at the end of its 5 months, this is how Wolder would record the collection. They would, so this one, whenever I'm doing it, I always start with the notes receivable because that's like a known amount to me. That was the amount loaned. So we're going to credit notes receivable. Then I calculate the interest revenue, which is the principal of 10,000 times the rate of 9% times the time of 5/12. And that comes out to 375, which is the amount of interest for the note. And then the cash will equal the amount of the note receivable plus the interest revenue we've earned during the period. So that's the order I do it in. I actually figure out my credits first because I need that to add up to my cash. Sometimes we have to deal with an accrual of interest receivable, meaning, I mean, if you think about it in real life, if we lend money to people, they don't always come due perfectly by the end of our fiscal year. Sometimes they go over into the next fiscal year. So all it means when we say we're accruing the interest is at the end of the year, we have to record the interest that's accrued. So here, they prepare their financial statements as of September 30th. So they have to do an adjusting any entry for any interest they've earned ending September 30th. So they do that by taking the principal times the rate times the time. So June 1st to September 30th is 4 months. So at the end of September, they would do this adjusting entry, interest receivable, interest revenue. And then when they get paid, they have to enter it this way. They have to show their notes receivable, so they're getting paid the full 10,000, plus the interest receivable that we had entered at the end of the fiscal year, plus any interest we've accrued since the beginning of this fiscal year. So we've done this concept before, okay, but it can just be confusing because it's like it was something learned in chapter 4 that they're dredging up on us again. I think back then I told everybody, remember these adjusting entries, they never go away fully. Anyway, so this is for when a note will extends across the end of a fiscal year. At the end of the year, we have to do the adjusting entry to show the interest receivable at the end of the year, and that's so we can record the revenue for that year. And then when we actually receive payment, we have to show that we're collecting the whole amount, which is the interest receivable from last year, plus any interest revenue earned this year, plus the note. All right. I know that's a lot of information as usual. These chapters are they're chock full, I guess would be a way of putting it. Any questions about the material I just covered or other questions from this week's homework? And if not, that's pretty good because we're actually at 48 minutes. We've
extra credit for being the only ones here.
It's not a required meeting. How can you get credit for it?
Guess it shows we care that, Brother Fox.
That is true. What stinks about the way things are set up in this class is that I'm so limited on the amount of extra credit I can give, and so I kind of do in the sense that I note down who's in the classes and or in these weekly meetings, and if somebody's like really on the edge of say like going up to the next letter grade or the next plus, or from a B to a B plus, or from a C minus to a C, then I do kind of nudge those up a little bit for people who are involved. So, but I guess the answer is yes, but it's not in some set amount because I find that limiting, and I actually would be probably more generous than the 1% I'm allowed to technically give. So that was a really long answer.
Nah, you're fine. I'm just teasing. So helping for having these meetings, they're really helpful.
Well, I'm grateful for you being here, and grateful to know that it does help some people. But if there's no other questions, we can finish up, and I can get to my meetings, and you can get on with your evening.
Sorry, I have a question here.
Okay, no, you're good.
For the account receivable turnover, for the net credit sales, I know for the question they always generous to write down very clearly for us to figure out the number for the net credit sales. For the net credit sales is the sales. Why here the specials say the net credit sales? Why don't just say the sales?
So in real life, many businesses will separate out cash sales from credit sales. So that way, because if you think about it, if we just include all of our sales, then we're kind of not getting an accurate figure on how well we are collecting. Does that make sense? Because the whole intent of those ratios are to give us a good sense of how well we're collecting money that's owed to us. But in the absence of that information, we just have to substitute net sales for net credit sales because we don't know. And then there's a couple of arguments in the field. One says if you allow people to make credit sales, then all sales are credit sales. Just some people chose to pay it right then, meaning if it was available as a credit sale. Anyway, so the short answer is just that in some businesses they do separate out credit sales from cash sales.
Just let's say just distinguish the cash and the credit sales.
Right.
Okay.
But I think for most of these problems they tell you just to use net sales as your net credit sales because you don't have access to the how much of them are cash sales.
Okay, thank you.
I know another potential variable in all of this. Okay, well, Michelle, would you be willing to offer the closing prayer since Sister Paul offered the?
Okay, my pleasure. Dear Heavenly Father, we thank Thee we can have the time to learn the financial accounting, and thanks we can have very nice instructor to help us to progress in this course. We ask Thee to guide us and help us to continue improve until the end of the semester, and we all can be successful in this course. We ask it to help keep health and help those people they are sick. Is our humbly prayer in the name of Jesus Christ. Amen.
Amen. Thank you. Have a great night.
Thank you.
Thank you. Good night.